There is perhaps nothing more dangerous in the world of speculation than a brilliant idea. It arrives in a flash of insight, elegant in its logic and seductive in its promise. It feels like a secret key, a map to a hidden treasure that you alone have discovered. And acting upon this raw, untested idea is the single greatest and most consistently fatal error a speculator can make. The markets are a graveyard for brilliant but unverified ideas. The novice trader enters this arena armed with them, collected from forums, whispered by so-called experts, or born from a gut feeling after watching a chart for a few hours. They see a pattern, they form a theory, and they mistake this creative act for sound analysis. They are convinced they are right, and the market owes them a profit for their cleverness. This is the foundation of ruin. Jesse Livermore learned this lesson not through quiet contemplation, but through the painful repeated process of losing his entire stake. He learned that the market has no obligation to reward your intelligence. It does not care about your beautifully constructed theory. It is a force of nature, and it respects only one thing: evidence. An untested trading idea is pure opinion. It is a hypothesis with no data. To risk hard-earned capital on an opinion is not speculation. It is the most reckless form of gambling. You are betting that your singular view of the world is correct, without ever consulting the one source that holds the answer, the historical record of the market itself. This journey from opinion to evidence is the defining struggle of any serious speculator. To understand the depth and difficulty of this path, the timeless chronicle of Livermore's own education, Reminiscences of a Stock Operator, remains the ultimate textbook. The modern analysis by Max Davidson, which breaks down each of Livermore's trials and triumphs chapter by chapter, is an invaluable guide to these lessons, and a link to it is in the description below. The hidden risk of an untested idea is that it is, by definition, a complete unknown. You are stepping onto a battlefield with no knowledge of your weapon's accuracy or your armor's strength. You have no idea of the probabilities. What are the chances of this setup succeeding? When it fails, how much does it typically lose? How many times in a row can it fail? Without answers to these questions, you are trading blind. Consider a simple idea: buying a stock when its 50-day moving average crosses above its 200-day moving average, the golden cross. It sounds logical. It implies a shift from a long-term downtrend to an uptrend. Many traders have taken this idea and run with it, risking their capital on its apparent soundness. But what does history say? Does this signal work on all stocks or only some? Does it work in all market conditions or only in bull markets? What is its statistical win rate? What is its average profit versus its average loss? An untested idea has no answers. It is a question mark upon which you are betting your entire financial future. When a trade based on an untested idea works, it is a disaster in disguise. The speculator is filled with a sense of genius. Their ego is inflated. I knew it, they think. My idea is the one. This single, random success gives them the confidence to bet even bigger the next time, reinforcing a potentially flawed process. When the trade fails, they chalk it up to bad luck, a fluke, or market manipulation. When a series of them fail, they are thrown into a state of utter confusion and despair. They have no framework for understanding what is happening. Their system has betrayed them, but the truth is they never had a system at all. They only had a guess. Livermore, in his mature phase, was the opposite of this. He was a scientist of market action. He kept meticulous records not just of his trades, but of the behavior of stocks under specific conditions. He was manually backtesting, studying the past to understand the probabilities of the future. He was replacing opinion with statistics. This is what testing provides. It strips an idea down to its statistical soul. The first thing a rigorous backtest reveals is the simple win rate. How often over the last decade and across hundreds of instruments did this idea produce a winning trade? The answer is often humbling and immediately exposes the weakness of many cherished theories. But the win rate is only the beginning. Far more important is the relationship between the average win and the average loss. An idea that wins 60% of the time can still be a catastrophic loser if the average loss is 3 times larger than the average gain. Conversely, a system that wins only 40% of the time can be a fortune builder if the wins are multiples of the losses. This calculation produces the ultimate metric, expectancy. Expectancy tells you over a large sample of trades what you can expect to make or lose for every dollar you risk. A positive expectancy is a statistical edge. It is the faint, almost imperceptible tailwind that, over time, will carry you to success. A negative expectancy is a headwind that will inevitably drive you into the rocks, no matter how hard you try to sail against it. Trading with an untested idea is trading with an unknown expectancy. You are, in all likelihood, trading with a negative expectancy. You are paying the market for the lesson that your idea is flawed. The professional speculator does the opposite. They let historical data pay for their education and only risk real capital on ideas that have been proven to have a positive expectancy. But this raises the critical question: how does a modern trader who isn't a programmer actually perform this rigorous testing? This is the exact problem that a tool like Expectancy was built to solve. It's a no-code strategy builder that allows you to take your unique trading ideas and translate them into a testable system using plain English and a drag-and-drop interface. You don't write code. You assemble your logic. Expectancy then generates the professional-grade code for powerful platforms like NinjaTrader or TradeStation, allowing you to run deep historical backtests. It's the bridge for the creative thinker, turning your brilliant idea from a dangerous guess into a statistically analyzed hypothesis, ready for the judgment of historical data. For anyone who has ever thought, I have a great idea but I can't code, there's a link to explore this path in the description. The process of testing is a great filter. It allows a speculator to take 100 different ideas and, with cold, unemotional rigor, discard the 95 that are worthless junk. This is not a failure. It is a monumental success. You have saved yourself from the certain financial death that would have come from trading those flawed ideas. You have preserved your capital, your most precious asset. But this path of the system builder requires immense time and effort. This leads to an alternative, equally valid path for the evidence-based trader. This is the path of leveraging pre-vetted research, which is where a service like Stock Market Guides comes in. Their team has already done the brutal work of filtering. They've backtested millions of combinations of stocks and patterns to find the small percentage that have a persistent statistical edge. Instead of building from scratch, you get access to their scanner and alerts, which deliver only the trade ideas that have already survived the testing process. It's for the trader who understands the value of a proven edge but prefers to focus their energy on analysis and execution rather than on invention. If your goal is to trade proven setups without the years of development work, the link to this done-for-you research is also in the description. Whichever path you choose, building your own system or using pre-vetted research, requires a level of intellectual honesty that most people lack. It requires you to be more committed to the truth than to being right. For those who have been burned by a can't-miss idea, for those who have felt the sting of a blown-up account, this channel is a place to rebuild. The psychological aspect of this is profound. Trading an untested idea creates a powerful illusion of control. The trader believes they are a master strategist, outthinking the market. They feel they have discovered a secret, a holy grail that no one else sees. This is the siren song of the ego, and it leads directly to ruin. The reality is that this trader has zero control. They are a leaf in the wind, completely at the mercy of random outcomes. They are a gambler at a casino, mistaking a lucky streak for a repeatable skill. The market, like the casino, holds the ultimate statistical edge against all who play without one of their own. Livermore's most devastating failures came when he abandoned his evidence-based rules and acted on an untested idea, often one given to him by someone else. His catastrophic loss in cotton was a direct result of trusting the brilliant idea of an expert, Percy Thomas, over the clear, contrary evidence of the ticker tape. His ego allowed him to believe in a story, and he paid for it dearly. The process of testing an idea destroys this illusion of control, and it is a painful process for the ego. But it replaces that fragile illusion with something far more powerful: genuine, resilient confidence. The confidence of a professional speculator does not come from the outcome of the next trade. It comes from the statistical certainty of their proven edge over the next 1,000 trades. A trader with a tested system can endure a string of 5, 6, or even 10 losing trades without losing their nerve. Why? Because their backtesting has shown them that such a losing streak, while unpleasant, is a normal and expected part of their system's performance. They know it is just statistical noise within a profitable long-term framework. The trader with the untested idea, however, is destroyed by 3 consecutive losses. They have no historical context. They panic. They abandon their idea and jump to the next one, repeating the cycle of hope and despair, forever searching for a magical formula that does not exist. Discipline is impossible without a tested set of rules. How can you be disciplined in following a plan when you have no statistical reason to believe that the plan works in the first place? You cannot. You will inevitably override it at the first sign of trouble because your belief in it is built on sand. The greatest risk a speculator faces is not a market crash. It is not a black swan event. It is not a volatile stock. The greatest risk lies between their own ears. It is the unexamined, unchallenged, and deeply held belief in their own untested ideas. It is the arrogance of assuming you are right without demanding proof. Livermore's entire career was a journey away from this arrogance. He started as a boy wonder who could guess the market's next move. He ended as a master who knew that guessing was a fool's game. He learned to subordinate his own brilliant ideas to the humble, tedious work of observation, recording, and confirming. He learned that you do not invent systems, you discover them. The patterns, the tendencies, the behaviors that produce a statistical edge are already there, embedded in the historical data of the market. The speculator's job is not to create, but to listen, to test, and to identify these faint signals in the overwhelming noise. A trading idea begins as a hypothesis. I believe that when X and Y occur, Z is more likely to happen. The amateur takes this hypothesis and bets the farm on it. The professional takes this hypothesis and says, "Show me." They go to the data. They ask the market's history. Is this true? How true is it? And under what conditions is it true? Only if history answers in the affirmative do they proceed to the next step, risking a small amount of test capital to see if the edge persists in live market conditions. The process is slow, methodical, and scientific. It strips all the romance and excitement out of trading and turns it into a business. This is why so few succeed. They come to the market seeking excitement, action, and the thrill of being right. The professional is there for one reason only: to execute a tested edge with relentless consistency. Their work is often boring. Their discipline is absolute. Their success is a byproduct of this process, not a goal in itself. So before you risk another dollar on your next brilliant idea, stop. Ask yourself the hard questions. What is the historical evidence for this idea? What is its win rate? What is its expectancy? What is its maximum historical drawdown? If you do not have precise statistical answers to these questions, you do not have a trading system. You have a guess. The market is an expensive place to find out that your guess is wrong. The intelligent speculator uses the cheap data of the past to filter their ideas, rather than the expensive data of their own trading account. The final lesson is this: the market does not pay you for having ideas. There is no reward for creativity or cleverness. The market pays for one thing and one thing only: the disciplined execution of a statistically validated edge. To turn your untested ideas into such an edge is to turn gambling into speculation, and to turn speculation into a profession.